Good morning, and welcome back to another episode of the Talk to Tanner Morning Show, where we go over tips, tricks, ideas, and exercises to help you, the entrepreneur, become the best version of yourself. And today's topic is about real estate and how there is one factor that has a huge impact on whether people make a lot of money in real estate or they get burnt and they lose. So most people who own a house, a single family home, most of them don't make any money on the house. This is data pulled that I was pulling from when I was doing my notes the other day from Fannie Mae and Freddie Mac, because after you pay your lenders, your agents, the closing costs, you're paying interest on the loan, and the amount of principal you're getting back. If you do the math, unless you hold on to these properties, most of the time, you're not going to make any money on it. Single family homes. And in general, people usually make their money when they sell a property and interest rates are low. People make most of their money when they sell properties when interest rates are low. So right now, interest rates are really high, and they'll probably go up a little bit more, but anyone who says that they know for sure, I don't take that for a grain of salt. I only take what the prime rate is today, because there's always the experts and people saying, oh, it's going to crash here, it's going to crash there. And that stuff, people are all wrong all the time on that. So I wouldn't trust that. Versus just over the last 40 years, rates haven't peaked, haven't gone to 9%. So it'd be a safe assessment that around like 8.5%, 9% would probably be around the ceiling. It might go up to 10. I don't know. But then hopefully pulling back, the Fed has a huge lever that they're pulling back and forth on this, and then when it pulls back down. But anyway, the point is, when properties sell for the highest prices and when there's higher demand, and demand is usually created when there's more buyers who can get loans on these properties, and they can more affordably get into it, and they can afford to bid a higher price. They can borrow debt at a cheaper rate, and more people can borrow this debt. So there's more people making the offers on the properties, and they're bidding each other up, forcing the higher values of the properties. So when it comes to making the money in the real estate, right now, I would say is a terrible time to sell houses. A terrible time. I think it's a terrible time to sell real estate in general. When interest rates go up, rental rates go up. Why does rent go up when interest rates go up? Because less people can afford to pay that big chunk of interest and pay that bigger payment, so they have to go rent properties instead, thus driving up the demand of rentals. So you can raise the prices for rentals because there's more demand in it. So a little supply and demand. This morning going through, I always love talking about this stuff because I know it sounds basic, but if you just, anyone who practices the basics consistently, they're the ones who usually know and can capitalize on opportunities. So it's good to remind ourselves and refresh ourselves on this kind of stuff. So one thing that can kill you in real estate is selling at a bad time. What is one way to go up with that? Is to not sell. I'm a big proponent of, as you can see before, we still have some show notes from the other day about the buy and hold method in real estate. And I still am a big firm believer in that, and how buying and holding through any time and just renting and having someone else, tell me an asset that does that, where you have somebody else making you rich, somebody else is paying off your debts and stuff like that. Somebody else is putting money on the table. Somebody else is paying for this. Somebody else is making us rich. It's one of the beautiful things about real estate and property. So buy and hold is usually a great, and you're like, Tanner, what if I need the money today? Well, if you're investing if you are investing, I'm here to tell you, you probably shouldn't ever be at a point to where you need your return back at a certain point, like right away. I understand that people do deals and they do bigger multifamily deals, and a lot of these bigger multifamily deals, they're only owned and held for like 5 to 7 years, and that's usually like a long time for syndications, and that's a talk for another day. But those bigger multifamily deals, sometimes that is a shorter holding period because that's like the debt structure and all that kind of shit. But point being, you want to try and have as long of a holding period as possible, because properties over time and rents over time, usually it's a long-term game. And that's how you usually make most of your money, is over the long haul. So over the long haul. And that's one of the handicaps to real estate. So with your investments, you're investing it. I'm under the mentality of, when we invest money, we're not trying to touch this shit until we're old. Like, you don't want, when you're investing money, the goal is to not touch it, so it can protect you and your family when you're much older and down the line, versus your income is what's dispensable and what is used today to help cover expenses, to help support the people you love and care about, and this and that. And income's more for that. Investments, just understand, it's usually really dangerous if at any point you're like, I'm going to invest in this, but I need it back in a very short period of time. Those schemes usually never work. Those partnerships usually are really tough to handle, and people's returns, and because it's just, the market's so unpredictable, and specifically with investing in real estate, most of the returns are based off of a longer period. So unless you have some value add strategy, you're flipping the house, or you're forcing appreciation on it, and even then that just equates to a ton of risk. So being very careful about demanding and needing your investments immediately back in the short term. Real estate is more of a long-term vehicle. And I'd argue that, I wouldn't argue, but it seems to me, in my experience and people who have been giving me advice, that any type of investing should be over a longer period of time, letting it appreciate, avoiding paying taxes to Uncle Sam. That is usually one of the biggest hiccups that just kills all of the growth and appreciation, the compounding effect, because money compounded off of a bigger lump sum is more money. So we want to be very careful about needing some type of immediate return or getting back. We'd rather make our money some income, job-based thing versus investments that need to be really fast-paced and quick. In my personal experience, the risk is too high for me. There's lots of people who make that work and make a lot of money doing it. My personal preference, I don't really make money doing that. So when we compare this to, say, Tanner, and you talk about the S&P 500 low index funds, I still think those are absolutely amazing. I still think it's a great time to buy those. I mean, it's just, if you look year over year, it's just lower. So, and it's done nothing but go up over the last. So if you plan on buying for the long term, always buying into those all the time, I think is usually a good idea. Just never really selling them. So again, under the same precedent, you're like, oh, but real estate isn't as good as stocks because you can't sell them immediately, because real estate, it's not really. So I could have, for example, one of our duplexes, there's a rough value that in my financial statements that it says what it's worth. It says it's worth X amount of dollars, but it's actually not worth that, because it is only worth what someone is willing to pay, what someone closes. Whether in your state you do, so when you close, a little side note, when you close, you either close with a title company or you have a closing attorney, depending on your state. Here in Illinois, we use attorneys. Like in Arizona, for example, they do title, or is it title? Yeah, it's attorneys here. No, I'm tripped up. I was looking up a bunch of states. I got to look that up. Making a note. I know for sure Phoenix. I have a client in Phoenix who was just using a title company. So title. But point being, the real estate, until it sells, you're not making any money on it. Until it sells, until it closes, until someone brings you in an offer. And we just got done talking about ranting on how it's really tough to sell real estate right now because there's less buyers in the pool. And this is where, and when interest rates go up, this is where investors start creeping out and they're like, hey, do you like your property? Maybe I could give you an offer. Maybe I could get you out of what you're doing. And then it's usually low, and usually you don't want to sell to that, the low ball offer. So the interest rates affecting who's in the pool, who's in the buying pool. So I probably couldn't sell these things today what I think they're worth. So that's a con. That's a con of real estate. So now we have to wait. We've increased rent on them, and it makes more money, which is great. And we've locked in long-term debt, so the payment's the same through this period. So the cash flow is actually increasing, even though if I sold it today, it would be less than what I could have sold it a year ago. So now you got to hold on and wait until interest rates come back down and there's more buyers into the pool who can afford to push the prices back up, and you can sell for a higher price. Main point from today, as before we wrap up here, is to be very careful on when you sell your property. When you sell, I would recommend that you never sell. If you don't have to, hold on to that shit for life. Give it to your kids. Let it keep compounding and going over time. So that's how generational wealth is made, and that's how a lot of people. I don't want us to get rid of anything. Hold on to all of it. Our home, our investments, all of it. I think we should hold on to it forever. I love U.S. real estate. I think it's the bee's knees. This stuff's great. I mean, really, when you really think about it, this is high quality, good living. And everyone needs a place to live. So I think demand will only continue to rise and things will continue to appreciate. So be careful when interest rates go up. Just understand it is a lot harder to sell a property, and you usually can compensate for that by increasing rents. And then it's no different. You can argue that stocks or S&P 500 indexes, those are what I like a lot. I'm not a financial advisor, by the way, just putting that out there. Those are just, I don't invest in individual stocks. I just like indexes with the top 500 companies. And even those, I'm investing in those, and I have no intentions of ever selling that stuff, ever. The market could shoot up a bunch, and then it'll shoot back down, and then it'll shoot back up like it always has and always will. And I'm not going to touch it. Not a professional. I don't know. I know Amazon's laying people off. What does that actually mean? What does that mean for the stock price and this and that? I don't know. And I don't have the time or the capacity or the care to dive into that. And just selling it when the market's up or when the market's down, people who try to guess usually get burnt. So just holding it for the long haul is usually the best advice I've been given. Everyone is in a different situation, right? So if you ever want to brainstorm, if you want to sit down and talk more about this, investment strategies, if you need just more accountability, you need a life coach in your corner to help support you through while you're brainstorming, while you're putting a plan together, while you're setting specific goals, please, you can click the Linktree link below, and you can always set up a free initial session with me, your host of the morning show. And other than that, that's pretty much all I had. I kind of bounced around a lot and paused a lot today, but the main premise is selling real estate when in bad markets is usually how people lose a lot of their money. So be very careful of that. And most people who make most of their wealth continue to just buy and hold for the long term, like we talked about in the past. And when interest rates go up, raise rents. If you do have to sell and you do want to make money, usually make sure that there's multiple offers on the table and interest rates are low so you can get a good price for the property. That's all we have for today. I hope you guys got some help out of that. I know that's kind of a weird wraparound thought. Took me some time to adjust that and this and that. So You guys have a wonderful, wonderful Friday. If there's anything I can ever do for you, please don't hesitate to reach out to me. Whether it's some coaching exercises or just some accountability or some brainstorming, this and that. I'm looking to grow in the coaching space. If you know any real estate professionals who need a life coach, they have a lot going on in the holidays. They're overstressed. They're not sure what their next step is. Please make an introduction. If you know that if you like this content, give it a like or share with someone who you think could benefit. It means the world to me. And for now, we got a bunch of other content to make for the next week. We're hopefully ramping up some content that we're making. And I will see you all Monday morning at 7 a.m. live Central Standard Time to hold me accountable, to hold you accountable, to hold us accountable to what? To achieve our number one goal. Let's stay on it. Let's stay together. Happy holidays, friends. And I will see you all bright and early Monday morning, 7 a.m. live. Cheers, friends. I'm out. Until next time.